A restaurant, a fast food chain, and a toy store walk into a bar. They all order the same drink. Then, two go bankrupt, and the other doubles its business. So, what's this drink? And did it cause these outcomes? Since the 80s, a little-known private equity strategy called asset stripping has drawn quite the controversy. It supposedly gutted workforces, killed iconic companies, and is allegedly on track to ruin the world. But is that true? This is my investigation into this potent private equity strategy. Is this a poison or a medicine with a lethal dose? The reality is far more nuanced than you might like. Fundamentally, asset stripping is pretty simple. It's when
a private equity firm buys up a business and then they try to take away the assets of the business, sell it off for literal parts with the hope that the component parts make more money than an actual business would.
So, understood this way, asset stripping is like buying an old jalopy for $100, taking off the wheels, selling those for $50, melting down the metal frame, selling that for $75, and leaving with $25 more than you paid and no car.
First, I'd like to say that asset stripping is a pejorative term.
Uh-oh, some discord here. Let me introduce my experts. This is Brendan Ballou. He wrote a book calling out private equity and is not the biggest fan. And this is Gustavo Schwed. He used to work in private equity and is more of a fan. Between both of them, we can get a pretty good look at the pros and cons of the massive private equity industry. But let's start with our terms. As Gustavo said, asset stripping is a negative word. It's like thief. There aren't really good thieves. So I could give you examples of different thieves and tell you they're all bad, or I could tell you about different people, and you can decide whether they're actually thieves. I want to walk you through 3 distinct cases. In each, private equity does things that might be considered asset stripping, but the results are wildly different in each case. This is the truth about asset stripping. Case study 1, Red Lobster. This past May, Red Lobster filed for bankruptcy. Since, news publications and industry experts have provided a number of explanations for their downfall. But one of the most popular has been asset stripping. So what happened? In 2014, this private equity firm called Golden Gate Capital bought Red Lobster for $2.1 billion. But Golden Gate didn't just pull $2.1 billion from its pocket. Instead, it used what's called a leveraged buyout, which allows private equity firms to buy a company using debt that then becomes owed by the company that was bought. Yeah, here's how it works. So when buying companies through a leveraged buyout, private equity firms have a few maneuvers to put them in an optimal position. First, instead of using their own money, private equity firms generally use other people's money in what are called funds.
Those tend to be institutional investors like pension funds, university endowments, sovereign wealth funds, etc.
Then the private equity firm creates a separate company which will actually purchase the target company. To get the cash it needs, the fund gives some money, then the rest comes from creditors as debt. Once it has enough money, the holding company then buys the target company. And for its last act, the acquisition company merges with the target company so that the private equity company now has full control of the target company, and the target company is responsible for the debt. So does the incentive just become paying off the collateral for that debt?
Oftentimes that's exactly what happens. And oftentimes that's why people do sale leasebacks.
So in 2014, Golden Gate Capital went through some version of this process to buy Red Lobster. With a bunch of debt to pay off, Red Lobster immediately sells almost all of its land to a real estate company for $1.5 billion. That helps with the debt, but Red Lobster isn't Bluetooth, it needs a physical connection. So through this sale leaseback, Red Lobster leases its land back from the company it just sold it to, essentially as tenants in an apartment they used to own.
And that deal meant that Red Lobster now had to pay rent in a deal that would increase 2% each year.
So Red Lobster goes on with life, now paying rent. Basically nothing happened to its sales over the next few years, and slowly ownership transfers. In 2016, Golden Gate sold 25% of Red Lobster to a fish company called Thai Union for $575 million. Then in 2020, Thai Union bought 24% more, becoming the biggest shareholder. Golden Gate then sold the remainder of the company to a group of investors, including Thai Union, for an undisclosed sum. In 2023, Red Lobster posts a $76 million loss, and then Red Lobster files for bankruptcy. So, what killed it?
It's tough to say, because when a company fails, everybody has an incentive to tell their side of the story.
What makes it even harder is the fact that many privately held businesses don't share their financials at all with the public. So, for example, I don't have access to Red Lobster's annual reports. But some things about the company have come out in its bankruptcy proceedings. The first explanation was
Endless shrimp.
Endless shrimp?
because that's iconic. Then people said it was Thai Union's bad leadership. One whistleblower article reported Thai Union led to a revolving door of CEOs, harassment from leadership, and a feng shui expert telling them their headquarters had bad energy.
Are you sure this is better?
Absolutely.
But ultimately, the company's bankruptcy claim revealed that it was kind of all of those things, plus Golden Gate's impact. First, selling endless shrimp for $20 all year round cost the company $11 million. Plus, Thai Union, Red Lobster's shrimp supplying owner, is being investigated for potentially forcing Red Lobster to stop buying shrimp from anyone but them, which led to shrimp shortages and higher costs. Then the Red Lobster CEO blamed inflation and the rising cost of labor and fewer people eating out. And lastly, the company's move to sell off its land was coming back to haunt it. Rent across 687 locations cost the company $190 million in 2023. And many of these locations were underperforming and paying above market rates. So, was asset stripping really the culprit that led to Red Lobster's bankruptcy? Dubious. Let's get to the next scenario, which makes private equity's impact a bit clearer. Burger King is an interesting company because it was bought by private equity twice, but the outcomes from each time were quite different. The first time was in 2002, when a trio of private equity firms came together to buy Burger King for $1.5 billion. Of that purchase price, they only paid $210 million of their own money. The rest was debt. Or at least that's what several reports say the details were, though again, because these aren't publicly circulated financials, the true numbers are a bit unclear. But if they are true, that means 86% of the price was funded by debt, which is exceptionally high, even for leveraged buyouts, which tend to be between 60 and 80%. But the private equity firms didn't do all that much to pay that debt off. Instead, they stripped one of Burger King's most valuable assets, its cash. Once the trio had control, they extracted some hefty fees and dividends from Burger King. But under the trio's ownership, Burger King's business barely changed. Over 8 years, the chain only added 750 restaurants, a growth rate around 1% per year. Although the private equity firms did cash out around $500 million in dividends and fees for themselves. But in 2010, 3G Capital, another private equity firm, came in with a different tactic. They buy Burger King for $4.3 billion, this time with about $2.7 billion in debt, or roughly 63% of the purchase price. It's a much lower proportion of debt than the previous private equity trio. Then immediately, 3G starts cutting costs. They cut $107 million in administrative expenses, and the overall headcount shrinks 60% at their headquarters. They also sell off virtually all corporate-owned restaurants, relying heavily on franchises instead. And of course, they pay themselves. In 2011, Burger King gets $400 million of debt, and 3G takes $393 million of it as a dividend. And in 2012, Burger King goes public yet again, though 3G retains 71% of the company. And since then, 3G has largely held on as Burger King bought Tim Hortons in 2014 and eventually created a parent company that now owns both of them. So they stripped assets, cut costs, and paid themselves. But these three charts show an interesting outcome. First, since 3G's acquisition, the number of Burger King locations has roughly doubled, reaching almost 20,000 worldwide in 2022. That means more people employed and wider brand reach. Second, Burger King's system-wide sales have generally sloped upwards, adding about $10 billion since 2015. And third, while Burger King's corporate revenue has gone down through the loss of corporate-owned restaurants, its revenue from franchising fees has stayed around $1 billion a year. So Burger King was asset stripped. Money was funneled out or used to pay off debt, its buildings were sold, its workers were fired, but in many ways, private equity seemed to help Burger King's overall business. Part of what differed was what assets were being stripped.
When the asset that's being sold is clearly not particularly relevant for the core business, then that's generally a positive thing. All they're doing is freeing up capital and shifting it towards a more productive use.
In both the cases of Red Lobster and Burger King, the companies needed the land where they had restaurants. But the franchising structure of Burger King made its corporately owned land more of a non-core asset, since franchisees could just pay rent themselves. Meanwhile, since Red Lobster's whole business model was centered on owning its land corporately, its plots were more core assets. So, is asset stripping good? Well, this example certainly makes it seem better. The final example shows the worst fears people have with asset stripping. In 2004, Toys R Us was gliding right along. It made $252 million in net profit from $11 billion in revenue. It had $2.2 billion in long-term debt, but its revenue and cash on hand could easily pay that off. Then in 2005, private equity firms Bain and KKR plus Vornado Realty Trust bought Toys R Us through a leveraged buyout. They spent $6.6 billion for the company, of which just 20% was in cash. So that meant Toys R Us now had to pay nearly $6 billion in debt. But for a while, things seemed fine. Toys R Us boosted its revenue up to nearly $14 billion in 2007 and recorded profits almost every year between the acquisition and 2013. And in 2013, the company hired 45,000 employees in the lead up to Christmas, and its Times Square location was open 24/7. But as time wore on, paying $400 million on debt interest annually became more challenging. And as people started buying more toys online from places like Amazon, the company's revenue began to fall. At the start of 2017, Jeffrey the Giraffe, who called me on my birthday once, still had almost $5 billion of debt. As a result, the company was diverting funds from operations to pay off debt. It cut back on cleaning its stores and whittled down its labor force, while managers apparently gamed customer surveys to avoid punishment for low performance. This left the company with grimy and dusty stores, while executives were somewhat oblivious to how bad it was getting. In August of 2017, the company tried to sell off its land in a sale-leaseback, but the deal ended up falling through. It's hard to know exactly how much the private equity owners made or lost throughout this transaction, but going back to the roots of how private equity buys companies, the responsibility is barely theirs.
It's a heads I win, tails you lose sort of situation. If the business succeeds, that's great for the private equity firm, which has put up very little of its own money. But if things go poorly, it's the company that's bought that's actually responsible for paying off the debt, and the private equity firm can more or less walk away from it.
Fundamentally, asset stripping and leverage buyouts are risky. These tactics push companies to the brink of bankruptcy in hopes that the debt load is just a bit less than the amount a company can pay off while staying alive. In a sense, private equity is squeezing every single dollar from a company. And because of that, quite frequently, companies fail. According to one analysis, companies that were bought through leverage buyouts were 10 times more likely to go bankrupt in a 10-year period than similar companies that weren't. So, is that a problem?
The use of leverage, when properly and responsibly used, is a good thing. It lowers the overall cost of capital of the company. It amplifies equity returns, and it helps private equity firms to deliver higher returns to its clients. When a private equity firm puts a lot of leverage or debt into a company, and then they mismanage the company, so that ends up in a bankruptcy, that's a very bad outcome for everyone. And that does happen.
So Gustavo argues that it's not inherent to the system to kill companies. But Brendan would say that it incentivizes risky behavior that often does kill companies and hurt people.
Private equity doesn't work when the people that are able to make decisions for businesses aren't held responsible. And that incentivizes a certain kind of short-term thinking that really can not just hurt our economy, hurt people.
You can always find examples that will cause outrage and should cause outrage. But if you look at it systemically, I don't think it's a negative role. I think it does result in a more rational deployment of capital.
The reality is that much of the world is already owned by private equity. Blackstone, the biggest private equity company, has over $1 trillion of assets under its management. And many of the brands you know have been owned by private equity, like Dollar Tree, Cinnabon, Birkenstock, 24 Hour Fitness, McAfee, Mrs. Fields. Even Morning Brew, a few parent companies up, is partially owned by KKR, one of the companies that saddled Toys R Us with debt. What both Brendan and Gustavo agree on is that there's space for the industry to be better.
Ultimately, if it's regulation that created the private equity business model, it's regulation that'll change it.
One example of regulation on private equity is the Health Over Wealth Act that Senator Ed Markey proposed earlier this year. It focuses specifically on healthcare companies owned by private equity, and it would require private equity firms to report how much they're taking in fees and adding in debt. The act would also add more restrictions and requirements on who can actually buy healthcare companies in the first place and what they can do with them, like whether they can do a risky sale-leaseback or operate with low staffing levels. But making the right regulation has challenges. Ultimately, leverage buyouts are a strange form of financial engineering. Based on who you ask, private equity's tactics are genius or detrimental. The question that we as voters, business leaders, and potentially future asset strippers have to ask is, what are we optimizing for? So is this poison or medicine? Depends who you ask.